War is, unfortunately, the most painful phenomenon in human history. Innocent people die, homes are destroyed, and sometimes entire societies vanish. However, throughout history, humanity has never given up on fighting and causing harm to one another. Today, as always, we will attempt to evaluate the economic outlook of the week by examining the underlying economic realities of the recent phenomenon of war from a broader perspective. Let's get started. As you know, every weekend, we analyze the commodity market, international markets, American stock markets, and cryptocurrencies. For the viewers of this channel, the topic of war is not foreign, as we have been following its development, unfortunately. I wish I had been wrong, and the increasing phenomenon of war did not manifest itself as distressing events around the world, even to the point of mentioning world wars. However, as you know, there has been a pattern throughout history. When the leading countries' affairs are in economic trouble, first, there are exchange rate wars against their resurgent rivals, followed by trade wars, and eventually hot wars. I have discussed that this is how it has unfolded historically since the Roman Empire, and I've emphasized that we have reached the final stages of trade wars, and heading towards the outbreak of hot wars because the United States, as the leading nation, feels that its economic supremacy is threatened, and it cannot afford the risk of losing its global economic leadership. Recent developments unfortunately reinforce this thesis. Everyone may interpret Hamas' recent attack on Israel and Israel's severe response and endless oppression as a long-standing tension between two countries or two communities, but we've explained that there is much more behind it. Those who believed that America, especially under Biden, was going to bring peace were greatly disappointed. We observed that America was actually fanning the flames of war through its actions, from its provocative behaviors to the deployment of American ships in the eastern Mediterranean, and there was no shortage of other countries following suit. Unfortunately, these recent developments indicate that war is set to continue, evolving and spreading to different fronts in the near future. This is, of course, very sad and harbors dramatic developments. When I mention these, I don't expect them to happen at the slightest provocation, but rather, I expect it to be a prolonged process. It won't happen in a day or two, maybe not even in weeks or months. It will be an extended process. This is because prolonged wars have always served the interests of major powers. Just as I explained that the war in Ukraine wouldn't end immediately because it was beneficial for Russia with rising energy prices, it was also beneficial for America to continue supporting the war there to consolidate its allies in the world. I've explained this in great detail on numerous occasions. I bring up such phenomena because when you look at the big picture, it was clear that war was coming. It's just a matter of where it will erupt and on which fronts. I believe it won't be limited to these, unfortunately. These developments will continue in this direction, and we need to be prepared, make our investments accordingly, and organize our lives accordingly. Therefore, in recent days, the demand for risky instruments, the riskiest instruments, has started to decline even more, and while there may be temporary fluctuations, behavior will change, especially as the concept of war slowly settles in people's minds. They will become more conservative, more protective, both as individuals and communities, and in market behaviors. Having noted this, let's not drag on. After summarizing the big picture, let's see what's happening. One last thing about the big picture. This morning, there was even a tweet saying that the reason for the war is not this but that. The news that China has overtaken the euro in international transfers has dropped like a bomb. Yes, the sole reserve currency is under threat. Therefore, to keep its economic power and counter the loss it has suffered in the economy, it is trying to maintain its strength with arms and power. You may ask what this has to do with it, but I want to share a graph related to the big picture. Look at this. The TLT is a 20-year U.S. Treasury ETF, which means it's the ETF version of the 20-year U.S. Treasury bond. If you want to buy this bond directly from the stock exchange to invest in international stock markets with U.S. Treasuries, when interest rates go down, its price goes up. Look, it was trading around 180 in September 2020, and it was even closer to 155, 21 months ago in December 2021, which is today, it's trading at around $83. In other words, in just 2 years, half of the money, 50%, has disappeared. What does this mean? When you invest in U.S. Treasuries, if you want to realize it today, half of your money has disappeared. I've been talking about this for a while. I wanted to show this graph again, especially when I couldn't get the point across in detail. This is what's happening in international markets. You might say, I haven't bought American bonds, I've invested my dollars in interest. However, this bond determines the benchmark for the whole world, and as long as central banks around the world do business with the dollar, they constantly invest in American bonds to prevent their money from being idle. Therefore, they are already financing America, and this keeps the dollar standing. However, recently, there has been a surge in harshly rising interest rates, and the system has turned into a duo box. China, Russia, and other countries are no longer buying American bonds or even excluding them, leading to the belief that bond prices will continue to fall and interest rates will rise. This, in turn, poses a major problem for the financial system today. In fact, it is an issue that is being ignored or pushed aside with wars. In reality, there is a massive financial issue in the system, and we are explaining the moves to eliminate this problem or to give power to the dollar through war. Let me give you a quick overview of the international markets and the American stock markets. NASDAQ is currently at $14,782. I want you to pay attention to my trend following level. We've seen sharp declines there throughout the week. As you know, we've been warning about this, that these movements don't have macro reasons behind them. In other words, if Federal Reserve Chairman Powell continues with the Fed's current stance, the markets will lose control. Yes, the Fed is continuing to shrink its balance sheet, but in an environment of rising interest rates, especially as the United States is preparing to allocate an additional $100 billion to Israel and Ukraine, this kind of monetary policy, unfortunately, doesn't work. It might seem to work in the short term, but it cannot prevent stagflation. Energy prices are continuing to rise, and no matter what they do, they won't be able to combat inflation. Unfortunately, long-term interest rates will remain high unless there's a depression, and only then might they try to bring buyers back into the bond market. I see a move in that direction right now. I believe that a major decline is still on the way. But there's one last support level, as you can see, in the $14,600 range. We closed just below the $14,580 range. In fact, this weekly closing was the most significant we've seen in months. But it will remain below $14,600. Of course, it depends on how the rebound will be if it's weak. But we can say that the possibilities of a much lower peak formation have started to emerge here. Technically, if it goes below $14,782, the direction is downward. Looking at the bigger picture, on the weekly chart, you can see that the peak in December 2021, at the beginning of 2022, was $16,777 for NASDAQ, and you know I've discussed the possibility of a major double top formation here, but it's really difficult to predict how far it could go. The S&P 500 is similar but weaker. You see, the S&P comprises 500 companies, whereas the NASDAQ has 100. They tried to manipulate it with a factor of 7, and they're attempting to manipulate the S&P with a factor of 7 as well. However, because there are 493 companies outside of the top 7 in the S&P, it has remained weaker than the NASDAQ. When it comes to its upward movement, it couldn't go to higher peaks. It reacted lower before reaching the top and tested a broken support level. Now, as long as the 200-day moving average at $4,271 remains intact, I expect more major selling to come in. If you are a short-term player looking above $4,271, you can take a positive short-term view. But the bigger picture still appears negative both in terms of the macro perspective and from various angles. This week, let's talk about NVIDIA. You know it's a crucial part of the bubble in major American stock companies, making up the top 7 of these companies. Why is it so important? Because, as we've discussed, there are various issues from accounting scandals to fictitious movements. The trend following level for NVIDIA is at $430. It has formed a head and shoulders pattern there, and the likelihood of it breaking will become much clearer this week. If it breaks its neckline, it could potentially lead to significant downward selling and have an impact on the entire NASDAQ. And then, there's Tesla. This week, they released their financial statements, which came in below expectations, resulting in a drop of over 10% in just 2 days. The decline continued, and it broke that critical $247 level. Looking at this chart, it's challenging to see anything positive. Everything is beneath it, and it's also below the 200-day moving average. In the formation that has developed below this level, the direction is still quite clear. It continues downward. The trend following level for Tesla is at $227. As long as it stays below that level, we can say the direction remains downward. As you know, we've discussed Tesla and Elon Musk multiple times. We bought it from the bottom at $100 and shorted it at $300 to $400. We've been closely monitoring Tesla for months. So if you stick to trend-following levels, you can trade this highly volatile stock without too much trouble. Let's quickly take a look at the American 10-year yields because this is one of the most discussed topics. The trend-following level is at 4.67, and you can see that levels like 5.12 and 6.15 are given as medium-term targets. Since this is a weekly chart, you can observe the movement from the lowest point, starting at 0.64, and how it has come to these levels. I will address the short-term chart in a moment, but on the weekly chart, we can see that the trend is still ongoing despite the pullback on the last day of the week. As long as we don't see a weekly close below 4.67, we can perceive that this trend is continuing upwards. However, unless a significant depression occurs that pulls prices down dramatically and people seek refuge in bonds, we might see some of the money exiting the stock market flowing into this direction. If the midterm scenario comes to fruition. So, our key level is 4.67. Now, in the shorter term, on the daily chart, we have witnessed a bearish engulfing pattern, so I am paying attention. It retraced to 4.91, but as long as it stays above 4.92 and the region around 4.81, the short-term movement could continue. However, there is a bearish divergence between the last two peaks, and if it attempts to correct this divergence, it could potentially drop below 4.50. Therefore, whether this divergence will be corrected or not remains to be seen. In sharp rallies, sometimes, divergences can form between a few peaks. So, I can't predict with certainty that this divergence will be corrected. There's no confirmation on the weekly chart, so we will keep an eye on this divergence. In times when stocks and yields move in opposite directions due to stagflation, gold tends to rise. Since the day I started this channel, I've been explaining this pattern to you. I've told you why periodic pullbacks are buying opportunities and how energy accumulates when the horizontal range is not broken. Finally, 2 weeks ago, when China's holiday emerged, they pushed down gold. We explained that this is the last opportunity. Of course, we received a lot of criticism and backlash because when we see gold and silver going up while having a negative view of the stock markets, for some reason, especially from the risk-loving younger folks, we face reactions. We're used to these reactions, it doesn't matter. We'll continue with what we believe is right. Look, we're not saying put all your money into gold and silver. You build your portfolio basket with products that will protect you. When they go down from time to time, you increase the amount of your basket in the horizontal period. When they go up, you reduce the amount and switch to riskier instruments. But now, in an environment where geopolitical risks are increasing, it's very difficult for gold and silver not to go up, especially with all the financial system issues I've been discussing. Gold's trend-following level is $1,927, and it has risen sharply and rapidly. Could there be a correction if some strange news comes out and disrupts the system? Maybe, and that might be the last buying opportunity. Other than that, the news is just for corrections and horizontal formations. I believe that the historic peak at $2,075 will finally be broken with this movement and rise. But formations may occur here. They might take a breather, of course, and I'll closely monitor those. Silver is currently at $22.70, and I couldn't create a detailed chart this week. Do you think we have medium-term high targets for it? Well, the possibility of breaking this 3-year consolidation is increasing, but I'm not saying it has broken out yet because for that, it needs to rise above $25.40. But when silver accelerates, you know it can suddenly move up a few dollars. So, in my opinion, pullbacks to $22 or $23 are cheap and affordable, and even the $20 range is very low. It was a fantastic opportunity. I had tweeted about buying physical silver at those levels, as I mentioned here. Now, if we get a short-term daily close above $22.70, the momentum will continue. If $25.40 is breached, the major scenario and the big scenario we've been discussing will start. Until then, we'll keep a close eye on it. It could be an interesting week for gold and silver. I've been closely monitoring the gold-silver ratio because the sales there will ultimately pull up all precious metals, and they are persistently trying to keep it high. In other words, they lost control of the tendency towards gold, but at least with the gold-silver ratio, swap traders are trying to divert the money there. So, when the gold-silver ratio goes down, both gold and silver will rise significantly. Please consider this as a note. I've been talking about this for months here. We're watching 3 different levels: $86.50, $84.70, and $78. We are currently around $84.70, but the dramatic shift will start when $78 is breached. However, at least the gold-silver ratio hasn't moved significantly yet. So, once that movement begins, the possibility of triggering it this week is quite high. There are lower targets for the gold-silver ratio, and hitting these lower targets means that silver will rise more significantly from below. This, in turn, would result in all precious metals rising significantly. We are going through historic times, so take this seriously now. In my portfolio basket, I don't ignore these products. In fact, when I talk about the risks in the stock market and mention my investments in gold-silver funds or physical assets, I sometimes receive backlash. But it doesn't matter, we will continue with our strategy. We mention wheat because, as you know, we've been following it since the inception of this channel. We followed its journey from $450 to $1,300, and then we followed the pullback, noticing that the decline started to become somewhat exaggerated around $700. We liked it when it reached the $600s and found it even more attractive when it hit the extreme low at around $500. These are divergent lows, and they began to give small signals of an upward movement. I believe it's an inexpensive instrument in these levels, and in my portfolio baskets, I've been gradually increasing the quantity almost every week. I'm anticipating an upward move, but for short-term players, as long as it stays above $561, the direction will continue upwards. We've discussed Brent oil, and there was a broad base formation there. As long as it stays above $90.65, I anticipate the upward continuation of the breakout. There had been a horizontal consolidation and resting phase for quite some time. Now, for the downward movement to become real, it would really need to drop below $90.65 with a stop loss. In the short term, we're looking at targets of $104 to $108. On the demand side, yes, it's taking a beating, but they will continue to put pressure on the supply side. By they, I mean OPEC Plus countries. So, with these ongoing war reports, it's challenging for the oil price to go down significantly. Natural gas experienced a pullback this week. You might wonder why natural gas doesn't seem to factor in the war risk. However, this is the East Coast natural gas, and as meteorological reports keep coming in about a warm winter, it's putting downward pressure on natural gas. I don't expect this to be a long-term trend, but if you look at it technically, there are 2 horizontal support and resistance zones around $3.01 and $2.91. If you're a short-term player, you can consider going long if it stays above $2.91, but if it breaks above $3.01, then I can say that the upward movement will continue. As for spot natural gas, specifically Henry Hub, it's the most traded instrument for East Coast natural gas in America, and it's the product behind the ETFs. So, you need to look at it accordingly. I was expecting a move towards $4, but this recent move, especially if you follow the trend following level, won't damage you in the short term. However, we also liked it when it fell to $2 and then went back and forth before making a move towards $3.50. From there, it fell back before reaching $4. Now, it looks like an opportunity to me, but it would get out of control and cause a delay if it goes below $2.91. So, carrying a leveraged natural gas position is very risky. Going long above $3.01 with leverage and setting stops below $3.01 could be an option based on the current outlook. And finally, let's talk about Bitcoin is quite volatile, and you might ask if it's bearish. Well, yes, I've been emphasizing that I want to see how Bitcoin behaves in this geopolitical scenario. There are claims that BlackRock in America is preparing an ETF with astonishing figures. If that happens, Bitcoin's price could skyrocket. However, there's no clear news on whether the SEC has fully approved it or not. If they do, of course, there will be a significant influx of Bitcoin purchases, and some extraordinary things could happen. But why would they invest such a huge amount, $9 trillion, and immediately boost the price? I'm not entirely sure, so this situation could also turn into a game. We will continue to be cautious. Also, from a technical perspective, it hasn't provided a clear buy signal yet. If you're a trader, you can trade upward in the short term as long as it stays above $28,500. But if it goes below $28,500, you should consider a downward movement. Unfortunately, there's still a possibility of the chart forming a head and shoulders pattern. Therefore, be careful and don't hold positions below $28,500. If it stays above, you can continue with a stop loss below $28,500. However, if it goes above $31,000, or even $31,700, and maintains stability there, the perception of Bitcoin having hit its bottom would be established. In that case, I would start looking at it positively. As for other altcoins, Ethereum is being closely scrutinized compared to Bitcoin because if Bitcoin makes a breakthrough, the rest of the altcoins might follow, but Ethereum has lagged behind a bit. It's currently at $1,638, and for Ethereum, trend followers should watch for it to break above $1,680. I'm negative about the levels below that, but positive above it. So, these levels should be monitored carefully. I tried to quickly compile various different products into a single video. I wish all of you a very careful, highly profitable, and wonderful week during these challenging times.